Today, the Australian market also takes a dive. Hello again, it's Martin North from Digital Finance Analytics. Welcome to our latest post covering finance and property news with a distinctively Australian flavour. And this is the last Friday before Christmas, but it was pretty nasty on the markets once again, reflecting the falls in the US, which we covered in our earlier post. So this is going to be just a brief summary of what happened today. But before we get into the numbers, I just want to highlight the fact that according to the CoreLogic data issued yesterday, auction clearance rates continue to fall last week. In fact, Cameron Cusher tweeted that the final auction week of 2018 has seen clearance rates of 40% across the combined capitals. That's the lowest on record, at 38.8% in Sydney, and that's the lowest since July 2008, and 44.2% in Melbourne, marginally higher than last week. And he also showed a couple of charts which demonstrated what had happened to Sydney clearance rates in recent years, and look where 2018 is, and also the same data in Melbourne. And again, it shows that 2018 is right at the bottom of the pile. And to my mind, this signals the likelihood of more home prices going down further next year. And with that, we'll go back to the markets. And the S&P ASX 100 closed down 1.24% to 4,485. The ASX 200 financial sector fell 1.92% to 5,264, and this chart shows the tracking of that particular index all the way back to 2002. And it's worth highlighting that this is the lowest the index has been since 2013. So essentially, 5 years of value growth have been taken out, and of course that's not allowing for the effect of inflation. That's a big deal. And we'll go through the individual banks. Bendigo and Adelaide Bank fell 2.05% to 10.05. Suncorp fell 4.02% to 12.40. The Bank of Queensland fell 2.76% to 9.16. Spot the common trend amongst the regional banks. Macquarie Group, who of course is exposed internationally, fell 2.96% to 104.11. And remember that they are up around 120 quite recently, so that's quite a considerable fall. Westpac, amongst the majors, fell 1.97% to 23.59. The ANZ Banking Group fell 1.61% to 23.17. National Australia Bank fell 1.32% to 22.78. And the CBA fell 1.71% to 67.74. And of course, again, the common trend is that all of those major banks are now significantly lower than quite recently. And again, this is worth remembering, this is before the final outcome from the Royal Commission in February. AMP dived again another 3.36% to stand at $2.30, and of course languishing well below their previous highs before all the issues came out at the Royal Commission. Mortgage Choice, the mortgage aggregator, fell again another 3%, 3.03 actually, down to 96 cents. And Genworth, the lender's mortgage insurer, fell again another 2.82%, down to $2.07. And Genworth, of course, is exposed both to the mortgage industry itself and also to the broader investment sector. And just to round out today's update, the Aussie dollar, US dollar was pretty static. It was actually up at 0.03% to 71.09. That's, of course, because the US dollar itself slid a little thanks to the US news. The cross rate of the gold spot to the Aussie dollar was up 0.94% to 1,771.65, and that reflects the strength of gold that we saw overnight. And the Bitcoin Aussie dollar cross rate was up 6.13% to 5,392, reflecting, of course, the recent moves up overseas. But, of course, again, we must highlight that Bitcoin is highly speculative and it could go up, it could go down. It's hard to know what its true value might actually be. And so, closing out this post today, it's worth reflecting again that the market continues to move into negative territory. The momentum is definitely further south. And this is also reflected in the volatility index. And interestingly, the S&P ASX 200 volatility index fell 1.17% to 2035, but still remains in highly risky territory. So there's a lot of concern and uncertainty in the marketplace, and we don't expect to see that changing anytime soon. And it's worth saying that at 2035, the index is significantly extended to levels last seen in 2016, but it's still significantly lower than in the time of the last GFC in 2008, when it was way, way higher. But nevertheless, fear continues to stalk the halls in the local market as well as the international market. So ahead, I'm afraid that I expect to see more volatility, more market movements, and more uncertainty. Now, just to update you, I will do a brief post tomorrow for the Property Imperative Weekly, but it won't be a very long one. And then over the next couple of weeks, we will still be posting, but perhaps a little more intermittently. So finally, just two quick things. Firstly, seasonal greetings to all the followers and watchers through our various channels, be it YouTube, on our social media, on Twitter, on LinkedIn, or on the Digital Finance Analytics website directly. Second thing to say is that we know that there have been a number of real estate and property sites that have effectively been taken down on YouTube relatively recently or banned from making live streams. So we have to assume that there is a risk that even DFA may be affected. The good news is that if for any reason we disappear off YouTube, you can still find us at digitalfinanceanalytics.com, which is our main website, and we will, of course, continue to post content there come hell or high water. I hope that we will be able to continue to use the YouTube distribution channels. We've certainly now achieved 12,000 followers, and that's tremendous, and thank you for all your support. But just in case, take a note of digitalfinanceanalytics.com. There's a link below. That's where you can always find us. I'm Martin North from Digital Finance Analytics. Many thanks for watching, and we'll see you next time.